My name is Malte, and this is my view of Oroco Resources Santo Tomas project. The analysis in this presentation is about where I think Oroco is headed and why I think it is headed there and its potential value. Before I start with the presentation, here is the necessary legal disclaimer. The views in this deck are obviously my views and are based on the analysis of publicly available data and information. This is not Oroco Resource Corp providing a forecast. Before delving into the predictive elements of this presentation, let's briefly recap what we know about Santo Tomas, its location and infrastructure. Oroco's Santo Tomas project has very good infrastructure. It has a railroad line passing in proximity of the property, going to the port of Topolobampo and also to Guyamas, both mineral export ports. Electrical hydropower is available in proximity, and a natural gas pipeline from the United States to the port of Topolobampo passes near the property. The region also has a strong history of mining culture. In addition to the excellent infrastructure, Santo Tomas also has a near-surface deposit, with high grades at surface and a very good mining jurisdiction in Mexico with a labor force that's trained in mining. Through historical drilling, a large resource has been established in the past. However, the key question is, where is this project headed in terms of size and valuation? How much of a re-rating are we likely to see? What are the comparables with regard to the upcoming PEA? And of course, what is the ultimate exit price? The remainder of this deck aims to providing answers to these questions. This slide shows the current progress at Santo Tomas. It illustrates that drilling is wrapping up or continuing at much slower pace going forward. The bulk of the work has been completed in the North Zone and South Zone. Brazilus will likely not be included in the resource, as only 7 holes have been drilled there, but the company indicated that they may be going back with Oroco's own rig in the future. Based on Oroco's timeline, the resource report will come out during the first half of the year, followed by the PEA. The PEA is designed to give the investor the scope of the project economics, the size of the resource, the net present value, the capital required to put it into production, etc. The PEA allows investors to understand the value of the project. Projects often get re-rated when the PEA is released. Using the results of the 2021-2023 drill program and looking at comparable projects allows for educated forecasts in the following categories: approximate resource size, the amount of high grade, the annual mining processing cost, CapEx range, the NPV range, and the internal rate of return. Let's look at the approximate resource size first. The resource size is the foundation for value. The historical resource was 821 million tons. The size is a key figure as Oroco needs around 875 million tons of mineable ore to operate a mill for 20 years at 120,000 tons a day capacity. The next step up would be a larger mill of 150,000 tons per day for 20 years, which would require 1.1 billion tons. So a key initial question is, will we reach these numbers? And the answer is yes, since your starting point is very close to the required tons. And the second question, which is equally important, is, will Oroco be able to find higher grades to run early into the mine life? This slide illustrates the potential of the resource by zone, with the South Zone to the left. The South Zone only saw minimal historical exploration, and this is where one can expect a significant upgrade in terms of tonnage. The company has released some very encouraging results with good grades and a tremendous IP signature, which should have much more than the 213 million tons of measured and indicated from the historical drilling. Infill drilling will further expand the resource in this zone. In the North Zone, which was approximately 608 million tons of measured and indicated, drilling has largely completed, and based on drill results, it is getting much larger. And the Brazilus Zone to the right is yet to be defined, since only 7 holes have been drilled here. Based on the publicly released drill results, Santo Tomas's size in the range above 875 million tons is very likely, especially considering the recent South Zone drill results, which show a significant expansion of the ore body. And it is important to note that these tons are just a starting point, and the resource will likely increase in size with additional drilling, especially in the South Zone. Let's look at select cross-sections of North Zone drill results so one can see the expansion of the North Zone. On this slide we have plates 49 and 51 showing holes 38 and 17. Both holes show mineralization far outside of the historical grade shell shown in the red outline. Hole 15 also shows mineralization below the historical grade shell. And the key point is that North Zone 38 has mineralization close to surface, which means a lower stripping ratio for the mining process. On this slide we have plates 57 and 59 with holes 14 and 29 again showing mineralization outside and above and below the grade shell. Additional holes like North Zone 39 and North Zone 12 also indicate mineralization above the grade shell, again improving stripping ratio. This is all very positive and indicates that the North Zone will be much larger than the historically defined 600 million tons. A similar trend continues on plates 61 and 63, so we're moving north through the North Zone, which shows holes 19, 21 and 37 outside the grade shell, again indicating that the North Zone will grow substantially from the historically defined 600 million tons. What this translates into is lower stripping ratio and better economics early in the mine's life. Less waste to waste piles, more ore to the mill, and this is all very exciting and positive. What is important as we look at the historical higher grades? There's approximately 8 years of higher grades for 120,000 ton per day mill. This is important to know as we forecast our grades over the years for building our financial model to approximate the value of this project. This is important to improve cash flow and generate return in the net present value. When you see the cutoff grades in the upper right, depending on cutoff grade, it shows that measured and indicated in the combined North and South Zone pits will range from 332 million tons to 446 million tons. This is quite interesting because this is before we drill out the resource, and it shows that historically we have about 6 to 8 years of these higher grades to drive the net present value and the internal rate of return. Lastly, do keep in mind that when these holes were drilled by prior operators, they did not assay for gold, silver or moly, and as such the actual grades are about 10 to 15% higher. Let's take a look at some of the results of the 2021-2023 drill program to see if the high-grade portion of the deposit can be enlarged. Here we have plates 65 and 48, and they both serve an example of the expansion of the higher-grade mineralization. We have North Zone 25 showing 0.68 copper equivalent from surface, and North Zone 36 showing 0.51 copper equivalent in a zone which historically had very limited drilling. So we are both confirming the higher grade mineralization, and we're also expanding it in areas that previously had very limited drilling. And so drill results thus confirm and expand the high grade portion of the North Zone. Two additional plates also show this trend continuing in the southern part of the North Zone and in the southern part of the South Zone. We have plates 44 and 44A showing 0.6% copper equivalent and 0.58 copper equivalent, including from close to surface. The expansion of near-surface higher-grade ore will have a positive effect on project economics. A critical component for valuation is forecasting the grades of ore that will be mined each year. On this slide you can see 3 scenarios because we know from the drilling that there is some high-grade material of 0.5 to 0.6 grade near surface. We know there's quite a bit of 0.4 and 0.45 grade for a long period of time. And then we know it also falls off to 0.35 and then to 0.3. As such, all scenarios have 1 year of 0.55 copper equivalent. For the high case, this then drops down to 0.5 for year 2 and then to 0.45 followed by a long string of 0.4 and then 7 remaining years of 0.35. The base case also has that first year of 0.55, but then drops down to 0.45 for a couple of years before a longer string of 0.4, 4 years of 0.35, and then 5 years of 0.3. The low case scenario also has 0.55 in the first year, followed by 0.45 and 0.4, but has 11 years of 0.3. I think a case can be made for all three scenarios. With the recent South Zone drill results from South Zone 18, the high case appears very feasible. Keep in mind, this is based on the fact that we have a historical resource that has these tons, that shows these grades, and that we also have drilling that shows that this has been improved and that the historical resource is accurate. In this slide, I'm attempting to estimate the annual operating cost for Santo Tomas with 120,000 tons per day mill or 150,000 tons per day mill. I'm using comparables from 6 mines with various annual tons to be processed and various annual operating costs to calculate a range of operating cost per ton of ore. With this range, it is possible to calculate the mean and a cost range with a 95% confidence level. In this instance, the high cost is $11.80 per ton and the low cost is $8.13. By multiplying it by the size of the mill Santo Tomas is expected to have, either 120,000 tons per day or 150,000 tons per day, we can arrive at the annual operating cost. We see that the mean operating cost for a 120,000 ton per day mill is around $430 million a year, and for a 150,000 tons per day mill it is $538 million. For the purpose of selecting an operating cost, I'm going with the mean primarily because I think energy cost, proximity to a port, and the fact that we're taking a mountain down, not digging a pit in an open area, will lead to favorable operating cost. And for this reason I think using the mean is appropriate and conservative. And on a further note, the OPEX costs noted in the February 2023 Los Andes PFS are consistent with the figures on this slide as well. I found 6 projects that are similar in terms of lower stripping ratio with different grades. I've then taken each financial model and recalculated the cost per pound as though they had a 0.5 grade in order to make them comparable. In other words, I reduced them to a common denominator. The key point here is to show that while grades differ between projects, different mill sizes and other variables, the processing cost of a copper porphyry deposit in a mill is relatively similar. And thus, when you calculate the mean cost per pound, one can see that the variance is only around 12 cents per pound at a uniform grade of 0.5% copper. This finding is useful as we can make an educated forecast about Santo Tomas's costs. Next, I looked for comparables to determine the CapEx required to put Santo Tomas into production. I selected 5 projects with similar construction characteristics to determine the CapEx range, taking into account mill size. This calculation results in a mean cost of $17.2 million per 1,000 ton of mill size. One can also determine that the margin of error to have a 95% confidence interval is plus or minus 1.5 million, which is not a lot. We then take the mean plus or minus the margin of error and multiply it by 120,000 tons per day. This results in a CapEx range for Santo Tomas of 1.88 billion up to 2.251 billion. For 150,000 tons per day mill, the cost can be adjusted accordingly to a range of 2.35 to 2.81 billion. For the purpose of calculating the NPV, I will be using the mean of these figures, as Santo Tomas's excellent location will likely result in CapEx savings. Next, we can apply the estimated CapEx and OpEx in a discounted cash flow model. A discounted cash flow model, DCF model, uses CapEx and OpEx figures together with projected future revenues from the sale of copper to determine annual revenues, net of taxes, royalties, etc., and applies a discount to each successive year of revenue at a predetermined rate. I used 8% as its standard in the mining industry and allows us to compare NPV and internal rate of return figures with other projects to arrive a present value of all future cash flows, net of CapEx and ongoing capital costs. A DCF model can also determine the internal rate of return, IRR, the measure of profitability of an investment. The inputs in the table are many of the variables included in the DCF model. Together with the other inputs, metallurgical recoveries, strip ratios, and others, these figures are used to generate each year's cash flow. In my model, I keep the annual operating cost, depreciation, and annual sustaining cash the same, and vary the grade for each year based on the expected grade to be mined, as we determined a few slides earlier. The next question is what copper price to use. A number of recent PEA and PFS studies use a price higher than $3. For example, last month PFS by Los Andes uses $3.68 copper. If we use the 3-year trailing average, which is often used, we can use $3.80 copper. A 26% rise in the copper price used in the DCF model results in the NPV and IRR increasing by 82% and 37% respectively. So the impact of what copper price to use in the DCF model is substantial. We can now plug the metrics we calculated in the first part of the presentation into this table to find out how Santo Tomas compares to other projects. I have selected Los Andes and McEwen, and we can see if these are truly comparable and how Santo Tomas stacks up in comparison. One can see that in terms of cost per pound of production, Santo Tomas is comparable. In terms of resource size, Santo Tomas is close as well. The average grade at Santo Tomas is also comparable to both projects. The CapEx, however, is lower than both Los Andes and McEwen. And the after-tax NPV and IRR are also in line with both projects. And taking a closer look, we realize that Oroco's NPV is calculated on the basis of 20 years, while Los Andes is 45 years to reach their NPV. And so the real question is, are the projects of Los Andes and McEwen comparable valuations to which we should aspire to, or is this a floor to the value of Santo Tomas? I contend that Santo Tomas is better than these other two projects, and as such, both Los Andes, copper, and McEwen should be considered a floor for valuation when compared to Santo Tomas. One can also apply a widely used rule of thumb to value a project using the contained copper metric. Here an average price for each pound of contained copper is used. Studies when copper was trading at $2.75 used between 7 and 9 cents per pound of contained copper. However, with copper above $4, a value of 12 cents per pound is more appropriate. Using this valuation metric and the estimated resource size from earlier in the deck, one can see that this rule of thumb matches with the NPV calculation derived from the DCF model. Thus, both the NPV derived from the DCF model and using the contained copper metric show that this is a great entry point for investors, assuring returns ahead of the re-rating at the end of the first quarter with the resource estimate, and again at some point during the second quarter with the PEA. Thank you for your time.